Today, I wanted to make a video on dividend stocks, and I wanted to go over some reasons why I am not a big fan of dividend stocks, and you shouldn't be either. I definitely don't buy a stock only because it's got a dividend. Now, what is a dividend stock? A dividend stock, by definition, is a company that is going to pay you a dividend to own their stock. Now, for the sake of an example, if you own a 100 grand position in a company that pays a 4% dividend, that means that that company is going to pay you 4 grand only to own their stock. Usually the payment is made quarterly. So in that case, your overall annual dividend would be 4 grand. And each payment that you're going to receive is going to be of $1,000. Now, there are companies who pay monthly dividend. There are companies who pay twice every year. It all depends. There are companies who have special dividends. Usually it's once a year when the company announces the special dividend. But anyways, the concept here is to make a passive income from the purchase of your stock. So in that case, you might be able to gain on the appreciation side and on the dividend side of the investment. Now, this might sound very appealing. It's nearly similar to owning a rental house. You bought it, you rent it out, it cash flows every month, and it's going to put money in your pocket every month, every quarter. So I am on board with the idea of buying dividend companies for that reason. And for most of you guys, might be a very viable option. It depends on your financial situations, on your age, your family situation, what stage of life you're in, if you are getting close to retirement or if you are already retired, if you are willing to put the work in it, or if you want to be more of a passive investor. But anyways, like it's been said, do whatever floats your boat. If you are retired, you don't have a lot of expenses, you have $1 million in your portfolio, and you want to put everything into a dividend paying investment. Let's even say that that investment is going to pay you 4%. In that case, for the sake of the example, let's say that the price is not going to change over the year. It's pretty stable, similar to a bond. In that case, you are going to profit 40 grand only for owning that position. Now, 40 grand is not a lot of money, but it could be definitely enough to cover your basis. And if you don't have a lot of expenses, let's say that your house is paid for, you already have a lot of the things that you need. In that case, 40 grand, it could be a good amount of money to live your lifestyle. And there is nothing wrong with that. But I don't think that's the best use for your money. 4% a year. Like I said, that means 1% of your investment every quarter. When you take into account that a stock might fluctuate 1% a day, and you can make that 1% by trading that stock. But let's even be conservative and say that trades on a weekly basis, and you have a 1% fluctuation on a weekly basis. That's pretty easy to accomplish. Now compare that to a payment of 1% every quarter. Now I know that the way that you pay taxes is going to be a little bit different. That also depends on your income bracket. I am sure that the percentage of taxes that you pay on capital gains is higher than the percentage of taxes that you would pay on your dividend income. But nonetheless, you're still going to have to pay taxes on those investments. But yeah, I do believe that there is a better opportunity by trading or by swing traded if you don't want to be there every day and daily trade your stocks. But you can definitely put your stocks in a rotation to where you buy with consistency, and as the market goes back up, you sell it at a rotation. You might even say, I want to profit 4% on the sale of that stock. In that case, you would buy with consistency. Let's even say that you dollar cost average and buy as the market goes down. You can keep adding to your pre-existing positions. And when the market goes back up, you might even have placed an order to sell the stock when it hits your objectives. So let's say that I buy a stock today and it's $100. Well, I can place an order to sell it when it hits 104. That's already a 4% gain on that stock. And you might accomplish that within a week, 2 weeks, 3 weeks of your initial purchase. So I guess where I'm going with this is that a 1% gain can be accomplished much easier. You don't have to be waiting a quarter to get that payment. It's not even worth it to have your money invested. You can access to it and wait for the quarterly payment. I believe it's a better use that you put a little bit of work in it and trade those positions. Now, why I am doing an example with the 4%? I think 4% is a good number when it comes to dividends, because anything less than 4% is not really worth it. Buying a stock that's paying you a 1% dividend, you're not gonna make a lot of money on that if you only focus on the dividend. Now, on the opposite side of it, buying a company that is paying a 6, 8, 10, 12, 14% dividend is a risk. Now, of course, a higher dividend yield might look on paper very attractive, and especially if they pay monthly dividends. You need money to pay your utility bills, need money to buy feed. You can use that monthly dividend to pay for your expenses. So that really seems something really appealing. But I'm gonna go and talk about these high dividend yield companies to make you aware that you're taking a chance. It doesn't mean that the company that presently is paying a 7% dividend is a better company than one that is paying a 4% dividend. Is that dividend safe? I understand that the 7% dividend might be very, very attractive. But if you look at the fundamentals of that company before you bought it, what is their company revenue? What is their company operating income? What is that company net profit? What history that company has of paying dividends? Now, there are so many things to keep into consideration in order to buy a dividend stock. Is that dividend really safe? So for that reason, I would recommend you that you pull up the fundamentals of the company and study the cash flow. You can go back 5, 10, 15 years and understand if that dividend is really safe. And of course, the higher the net profit is, that's a good indicator. If the net profit has been growing over the past few years, that's a good indicator. A track record of paying dividends and raising them, that is a good record. The other thing, shares outstanding. If a company has a history of buying back their shares, that's a good sign. But if a company has a history of diluting their shareholders, that's not really a good sign. I don't think so. Because now your percentage of ownership in that company has decreased. So there are a lot of things that comes into play to make the right choice. The other thing that you want to look for in a company is the payout ratio. Now, what is the payout ratio? The payout ratio is a percentage of the dividends that that company is going to pay that year over the net income. So, for the sake of the example, if the payout ratio of a company is 50%, that means that that company is going to allocate 50% of their income to dividends. If a company payout ratio is 10%, that means that only 10% of that company's profit is going to be allocated to pay the yearly dividend. I think that's a pretty good scenario and a way better scenario to guarantee that the dividend is safe and for that company to have extra money to invest in other things like R&D or recruiting talent or investing in new technologies. Now, what is the opposite side of the spectrum? That a company is paying 90, 95, 99%. Now, what that means is that 99% of that company's yearly profit is going to go to dividends. That's a pretty risky scenario. That's distressed territory for me. If a company needs to pay 99% of their profit to their investors, it's risky. I'm looking at it like if I was the company's owner. Imagine paying 99% of what you make to investors. I don't think it's a sustainable scenario. Now, if you think that 99% is a lot, there are companies with payout ratio over 100%. So if a company has a payout ratio of 110%, that means that that company needs to come up with more money than they profit in order to make those payments to dividend investors. Now, that company might have bonds and other things. So you really want to make sure that you study that company closely in order to pull the trigger on a company that it's paying a 10% annual yield. Now, I'm going to say this again. I know that a higher dividend yield is very, very attractive. So what does a company do if the payout ratio is over 100%? They can cut costs, but is that really what you want from a company? Cut cost. Would you save $100 on an airline ticket if the airline says, okay, we're going to give you a price break on the ticket, but we cut our maintenance costs in half? Would you be feeling safe on that plane? I don't think so. What other ways there are? They can dilute you as a shareholder. They can increase the amount of shares outstanding. And like I was saying, now your percentage of ownership on that company has been diluted. And there are companies that they have a track record of doing that. Now, of course, diluting shareholders is not always a bad thing, but it all depends on what the company is planning to do with that money, the money that they raise. Paying dividends, I don't think it's the best choice for a company. So again, there are a lot of things that you need to consider before buying a dividend stock. The other thing that they can do is go out there and borrow money. Go to a bank and borrow money in order to make those dividends payments. But is that really a good idea for a company to go out there and borrow money at a 5, 6, 7% interest and paying a dividend which is 7, 8, 9, 10, 11 interest rate? So it doesn't really make sense. Now, in the short term, it might make sense if they can come up with the money to pay debt off. I think that might be a viable option. But a lot of times the company is not going to be able to do that. If they need to go out there and borrow money, I don't think it's a good strategy, especially with the interest rate of today's date. So you see where I'm going with this. Um, the other thing that I was talking to you about is to make sure that the company has the financial strength to make those payments safely. There have been many companies in history that cut their dividends, and there have been companies who cut their dividend altogether. Now, this could be caused by a major event, and in that case, the whole stock market is going to dip a little bit. Now, it depends. It can be a war, whatever happened in 2008, 2009, the financial crisis, when all of those financials, they all had to cut their dividends. You can look back on the dividend history of all of those banks, not only domestic but international, and they all had to cut their dividends. All of them. The Bank of America, the Wells Fargo, and of course all the minor banks. Actually, in 2008, 2009, not only did they have to do that, but their stock price was slashed. Do you remember what happened to Citibank, to the Citibank stock? The other thing was the pandemic. What happened in the pandemic? All of those energy stocks, all of those oil and gas companies, they all had to cut their dividends. All of them. Now, imagine if you were a dividend investor during the financial crisis and you had a lot of bank stocks in your portfolio. You'd be very hurt financially from the appreciation viewpoint of your investment and from your dividend income. Now, those companies, they were very appealing. A bank usually pays a 3% minimum, which is a good dividend, 3, 4, 5, 6. International banks pay even much more than that. So you would be hurt financially. And if you own energy stocks during the pandemic, those companies, they had a very good track history of making dividend payments. All the Exxons, the Chevrons, Marathon, all of those companies, they saw their stock price being slashed and the dividend went away. So one of the things that you can do to screen some very good dividend stocks is to look back at history. Look at the dividend history of that company. I use Seeking Alpha. I have no affiliation with them, but I think it's the best website to look at the dividend history. And you'll see that all of those companies, 2009, 10, they all had to slash their dividend, and they did it overnight. And very slowly, they raise it back up. Very slowly. Now, you see, this can be a problem. This can be a very huge problem for the dividend investor. You see, what happens with dividend companies is that their stock is owned by dividend investors. Makes sense, but have you ever contemplated this? And what happens to dividend investors when the dividend gets cut or when the dividend gets taken away? They are gonna sell, and they're gonna sell by the bulk, and that's gonna trigger a huge downward spiral. All of those stop losses are gonna kick in. People are gonna panic sell, and the stock price is gonna be slashed. So this is a problem with dividend investors, because the only reason that they own their stock is to collect dividend. There was a company that was paying a very generous dividend. For the sake of the example, let me pull up Heinz Brands Incorporated. This is a company that makes underwear. It's in the textile company. Now, this company used to pay a very generous dividend. I don't want to say one thing now for another, but I wouldn't be surprised if this company was paying over 7% dividend. And of course, they had some financial difficulties. They had to cut the dividend first, and then I believe that they had to remove the dividend altogether. And if you look at the 3-year chart, this company went from 20 bucks a share. Now it's trading at $4 a share. Now, I want to say this one more time. This company in 2021 and 2022, it was worth about $20 a share and paying a big dividend. And it was very attractive to dividend investors. Now it's trading at $4 a share. Now, imagine if you were an investor in this company because you are looking for a high dividend company. You would be very hurt. It doesn't make sense to hold it anymore. You bought it for the dividend. It only for the dividend. Now, I don't doubt that this company was in a good shape. I mean, they are in the textile industry. There is always going to be demand for that. This could even be a Warren Buffett type of company. Can be in the consumer category. It could be very appealing. But look what happened to this company. You would have lost on the dividend side. You would have lost on the principal side of things. You're gonna have to lose sell at a loss. And on top of that, you still are liable to pay taxes on those dividends. You would have lost everything. Now, this was just an example, but there are many, many companies like this. Now, keep in mind also that every time that you collect a dividend, you trigger a taxable event. So that dividend, which on paper is 4%, is really not 4% because you're gonna have to pay taxes on that. Well, it's gonna be less than 4%. But what is inflation? what has inflation been over the past 5, 10 years? Now, you all know what happened during the pandemic. Inflation has skyrocketed, literally skyrocketed. Now, historically, inflation is about 2%, 2.5%. I personally think that it is much higher than that. That's the number that the government is gonna make you believe that it is. But just look at the oil prices. You've been buying groceries recently? I bet you are. You have. You've been paying your insurance premium recently? Your mortgage payment? Everything has gone up and has gone up much more than 2, 3, 4%. Have you bought eggs recently? So really buying a dividend investment that is paying you 4%, is that really worth it? You might not even be keeping up with inflation. I don't know. I'm gonna leave the answer to you. Now, let's look at some attractive dividend companies. One company that is very popular within this sector is Altria. Altria, the ticker is MO. This company is in the tobacco industry. Now, this is a good company. I don't know if you want to invest in tobacco. I know that for other reasons, there are people who feel like staying away from tobacco and alcohol. I believe this comes under the sin stocks category with gambling stocks. But anyways, this company looks good on paper. The fundamentals look good. Market cap of 73.5 billion. PE ratio about 8.5. Yield is about 9.5. It's got a 9.5% dividend. Very, very, very appealing. But what happened to this company? If you compare, let's see, on a 3 months basis, it's nearly flat. On the yearly basis, nearly flat. See, you collected the 10% dividend over the past 3 years. Over the past 3 years, it's still flat. 3 years. You collected the 10% of your investment the first year, the second year, the third year. It actually could have been less than 10% because that's a percentage of the stock price. 10% is the yield as of today. But anyways, this company over the past 3 years was flat. Now, if you compare that to the, let's just say the XLP, the XLP is the consumer staples. You were better off buying the consumer staple ETF over the past year, over the past 2 years, over the past 5 years. Over the past 5 years, consumer staple ETF is up about 50%, and Altria is flat. This happens a lot with high dividend investor. Usually, you're not gonna get much appreciation. You're gonna collect that dividend. But if you compare that, let's compare it with the S&P 500 ETF. over the past 5 years is up nearly 100%, while your investment is flat. Well, I'm gonna ask you, do you think this is a worthwhile investment? Altria. Now, let's see Pfizer. This is another good company on paper. The fundamentals look good, the net profit, all of that, very established company. This company over the year, it used to be a $50 stock. Today is trading at 29 and a half. Over the past 2 years, this company was trading, I would say, about 55 down to 30. Compare that with the XLV, which is the healthcare ETF. You would have been better off by a lot buying the ETF, taking less risk, collecting a dividend in the meantime, and you wouldn't have lost anything on your principal. Now, with Pfizer, you lost about 50% of your investment because you bought it 2 years ago or 3 years ago for the only reason that it was appealing from the dividend viewpoint. Compare with the broad market ETF, it's the same story. You would have been better off buying the broad market ETF, collecting not as much dividend, of course. I think the broad market ETF returns about 1.5 yearly to investors. But nonetheless, definitely a better choice would have been to buy the index fund. Now, Pfizer, as of today, pays a 5.7% dividend yield. P/E ratio of 16. It looks pretty good on paper, but again, I think I got my point across. The other one, let's say that you are a banker. That's what you know, financials. You bought Wells Fargo. You bought Wells Fargo for the only sake of the dividend. Over the past 3 years, it went from 30 to about 50 because there was the low of the pandemic, I believe. But this stock price really hasn't gone anywhere since January 2015. This stock was already a $50 stock in January 2015. Now, what is this? January 2024. And it's trading today at 49.93. Now, this was a company that it looked good on paper. Actually, I believe that this is number 2 or 3 top banks in the States, paying possibly a 4.5% dividend. But again, what happened to your principal? You've lost everything. Now, over the past year, is a little up. Compared to the financials, the XLF is the financial ETF. XLF over the past 2 years is a bit up. But to me, it's not really worth taking the risk to buying Wells Fargo as opposed to buying the sector of the industry. I think it's important to state the reason why you are buying that company. So you bought Wells Fargo for the dividend. You would have been better off buying the index fund. From a viewpoint of the overall investment return, and what I mean by overall, it would be the dividend and the appreciation combined, you would have been better off buying the index fund. Now, an alternative to that would be the dividend ETFs, and they come in a form of high dividend ETF. One very common is the VIG. Now, the VIG is actually a dividend appreciation ETF that I'm going to talk about in a second. But if you are a fan of collecting dividends, my best advice to you would be to buy the VYM. VYM is the Vanguard High Dividend ETF. Now this pays, let's see, it pays about I'll tell you in a sec. Guess that this pays less than 3% dividend, and you call that a high dividend? 3%. But nonetheless, it comes with good companies. Let's see, the top holdings of this are JP Morgan, Exxon, Broadcom, Johnson & Johnson, Procter & Gamble, the Home Depot. If you need to buy a dividend investment, I think it's a pretty good choice. It's diversified. First company is a bank, second is a gas company. Broadcom, a chip company. Johnson & Johnson can be a consumable or a pharma company. Procter & Gamble is a consumable. I think it's a pretty good choice, but again, you're talking about 3% dividend. If it's worth your money, I don't know. You tell me. The other company that is similar to this would be provided by Schwab, which is SCHD, which is their high yield ETF. But again, the point is that those companies are paying only 4% dividend on a good day. And like I was saying, it's not the best use of your money. Now, the other thing that you can do is buying the dividend appreciation ETF, that it combines dividend companies with the appreciation. And here you find the Microsoft, the Apples, United Healthcare, JP Morgan again, Visa. Now those companies have the potential to grow their stock price. At the same time, they pay dividend, but their dividend is not that good. I mean, only from the dividend viewpoint, Microsoft pays about 1%. I don't know, Apple might be around the same amount. So again, it's always a trade-off. What you make on the dividend, you lose it on the appreciation and the other way around. Now, what's funny is that a lot of people look at companies that don't pay dividends like being Ponzi schemes. Let's say Google does not pay a dividend. Meta does not pay a dividend. Berkshire does not pay a dividend. And a lot of people look into those companies like, okay, I can only profit if there is a buyer willing to pay more than what I paid. So it seems like a Ponzi scheme, but really it's not a Ponzi scheme because you're buying ownership in a company and there are fundamentals to back that company performance. So, like I was saying, the revenue, the profit. So it's not, I believe that actually the opposite is truth. Like dividend paying companies, a lot of times those companies, in order to attract investor money, they have to provide a higher yield and a higher yield. And the following year, again, they need to keep that promise of raising dividends. And what happens if they're not going to be able to meet those criteria? They're going to be going through some tough times. Actually, I believe that you should do the opposite of looking for yielding companies. Notice what happens to the stock price every time around the ex-dividend day. Now, do you know what the ex-dividend day is? In order to collect the dividend payment, you need to own that stock by the end of the day prior to the ex-dividend date. So, what's today? For the sake of the example, if today was the ex-dividend date, you need to own that stock by 11:59 p.m. of the day before. So what this does, it triggers a lot of money flowing into that stock on that day. And what that does is going to increase the stock price. Now, going back to the example of a company stock that's paying a 4% annual dividend. And like I was saying, in that case, if the dividend is paid quarterly, your yield would be 1%. Okay, so now in that case, if the day or the days before the ex-dividend date, in that case, the stock price, only for that reason, because the ex-dividend date is approaching, a lot of dividend investors are going to push that stock price up, and they can push it up more than 1%, 1.5%, 2%. So now you're buying this stock already at a premium, which is 1% or 1.5%. To accomplish what? To collect a quarterly dividend pay, which is 1%. So what you're gonna make with that dividend payment over the next 3 weeks. Usually the dividend is paid 2, 3, 4 weeks past the ex-dividend date. You already lost the moment that you bought that stock. So you bought it at a 1% premium. You're not going to collect the payment before 3, 4, 5 weeks. And the following day, the ex-dividend date, you see that the stock price has gone down. Because all of those people who bought that dividend stock for the dividend, only for the sake of the dividend, they're gonna sell. And the stock price at that point might dip 2, 3% for no reason. The company is the same. Nothing has changed within that company. They have the same employees, same CEO, same revenue. Nothing has changed with that company over these past 3 days. But yet again, the stock price has gone up and has gone down, only for the sake of the ex-dividend date. Really, I think you should do the opposite. You're gonna collect the 1% in the next 3, 4, 5 weeks. Think about it. You were better off doing the opposite of that. You were better off buying that company stock and selling it when everyone else was buying it. You were better off selling it the day before the ex-dividend date. And if you want to do another thing, which is smart, is buying it again the day after the dividend date. So playing a complete opposite game than all of those dividend investors were doing. You are selling when everyone else is buying. And if you want, you can buy it back when everyone else was selling it and trading it. In that way, you would have made 1% and another 1% in 3 days. As opposed as buying it for the dividend at a premium, wait 3, 4 weeks that dividend payment is gonna show up in your trading account transactions. So I nearly believe dividend stocks are a Ponzi scheme. Now, of course, this behavior is more pronounced with high yield dividend stocks. Stocks that pay 8, 9, 10, 11%. You'll see a lot of stock price move around the ex-dividend day. Now, what I was saying at the beginning of the video, if you really want to do something smart, invest in a dividend ETF. Now it's your choice. You want to invest in a high yield dividend ETF, or you want to invest in a dividend appreciation ETF. Look, you're going to make at the end of the day the same amount of money, taking less chance. Because everything can happen to an individual company. Everything. Overnight, anything can happen. A bad news comes out overnight, and before you can even do anything on that stock, you already lost 5, 10, 15%. And now you really hurt financially. Yeah, you can wait for the dividend payment. Every quarter you might be collecting a couple of percentage points. But really, when you lose 5, 10, 15, 20, 25% on the principal, if you lose 50% on that principal, that means that that stock price needs to go up 100% in order to go back at even. It's not going to happen. On top of that, you're going to have to pay taxes. You lost everything. You lost on the principal, collect a little bit of dividend. It's not good on anything. Once you have lost that amount of money on your principal, then again you're going to have to pay taxes on that dividend. You only generated a taxable income. Really? Who wins all the times is the IRS, is Uncle Sam. And this is why there is always going to be a stock market. It's never going to go away. Up until there is a government, up until there is a revenue system, this thing is always going to thrive. Because the real winner is always the IRS. Now, here, some of you that want to venture in international dividend companies, there are a lot of options here. Matter of fact, those international companies, they pay even a more generous dividend. Now, I'm looking here at a company which is Vanguard, and they provide a Vanguard International dividend appreciation. And those are all good companies included in this. Novo, SAP, Novartis, Nestle, Roche, Toronto and Dominion Bank, it's a Canadian bank, Sony, Sanofi. Those are very good companies. But again, if I look at this ETF over the past year, is up a little bit compared to the S&P 500. Compared to the S&P 500, this company is up about 10% over the year. S&P 500 up 20%. Over the past 5 years, same story. S&P 500 up by 75% and over. This is up a little over 25%. You better off buying the S&P 500. Like in most of those cases, S&P 500 is the best choice. What is the dividend that this pays? A 1.9. S&P 500 pays a 1.5. S&P 500, the cost to alternate is about 3 basis points. They charge you here 15 basis points expense ratio. 15 basis points. It doesn't seem much, but it adds up. It actually, compared to those ETFs, like I say, usually it's 3 basis points to all the S&P 500, 6 basis points to all the something a little bit fancier. But again, now you are paying 15 basis points to own this international dividend appreciation ETF. Is it really worth your money? I don't know. I'll leave it up to you. I feel like it's time to wrap it up. I don't know what dividend stock you're going to be shopping around, but I'll tell you what I'm going to do. I'm going to buy the S&P 500. Thank you very much.